All right, let's dive right in. Welcome to today's Explainer, where we're stepping into the fascinating, incredibly high-stakes world of banking balance sheets. Today, we aren't just glancing at spreadsheets. We are putting you directly in the hot seat of a professional bank risk manager.
It's the ultimate question, isn't it? Could your bank survive a sudden, massive panic? We are going to explore what actually keeps a financial institution afloat when a true crisis strikes. And trust me, it is not just the heavy steel vault door down in the lobby. It's the complex, highly strategic plumbing of the bank's balance sheet.
Here is our briefing for today. We're going to break down the bank's balancing act, tackle the twin threats of interest rate volatility and liquidity challenges, autopsy the Silicon Valley Bank collapse, and finally, unpack the risk manager's ultimate defense.
Starting with Section 1, the bank's balancing act. Let's look at how the foundation is actually built.
The secret to a bank's survival really boils down to three letters: ALM, or Asset Liability Management. You can think of ALM as the literal cardiovascular system of a financial institution. It's not just the muscle that absorbs a shock, it's the constant strategic coordination of everything the bank owns and everything it owes, making sure the whole body stays alive and pumping. Because banking, it's the ultimate tightrope walk. On one side, you've got assets. We're talking customer loans, cash, investments. These generate your returns, sure, but they bear risk and they're usually locked up for years. On the flip side, you've got liabilities, primarily customer deposits. These fund the entire operation, providing the vital cash to make those loans. But here's the catch: they are easily spooked. They're subject to sudden, almost instantaneous withdrawal.
Which brings us to Section 2, Threat 1, Interest Rate Volatility. Meet the first major villain in our risk manager's story. When interest rates stay low for a long time, banks tend to get a little too comfortable. But when central banks aggressively hike rates, it's like a jagged staircase straight up. And that sudden spike, it actively destroys the underlying value of those long-term, fixed-rate bonds sitting over on the bank's asset side.
So the real danger here is repricing risk. Picture this. You fund a 10-year fixed-rate mortgage using the cash from your customers' checking accounts. Those deposits are basically overnight liabilities. They can literally walk out the door tomorrow. So if rates rise, you suddenly have to pay higher interest just to keep that cash in the bank. Almost overnight, your short-term funding costs completely eclipse the locked-in earnings on your long-term assets. You start bleeding money. When you look at the raw math of a gap analysis, this dynamic becomes crystal clear. If you have more rate-sensitive liabilities than assets, what we call a negative gap, rising rates will absolutely crush your net interest income. On the flip side, a positive gap might actually benefit from rate hikes. As a risk manager, your entire existence revolves around measuring this gap and hedging against those devastating swings.
But interest rates are really only half the battle. Let's move to Section 3, Threat 2, Liquidity Challenges.
Here is the truly terrifying truth about banking. You can be completely solvent on paper. Your assets can mathematically outweigh your liabilities. But if you suffer from severe liquidity risk and can't hand actual physical or digital cash to the panicked customer standing in the lobby, game over. You are totally dead in the water.
And managing this threat means trying to predict the unpredictable. As a risk manager, you aren't just modeling math, you're modeling human psychology. We call this behavioral option risk. In our hyper-connected age, a single rumor spreading through a WhatsApp group can spark a digital panic that drains your entire deposit base overnight.
Let's move to Section 4, our case study on Silicon Valley Bank. We'll see exactly what happens when both of these villains attack at the exact same time. The fatal error here was incredibly straightforward. SVB's management essentially bet that interest rates would stay low forever. They took short-term customer funds and parked them in longer-term securities without properly hedging the interest rate risk. When rates inevitably spiked, those bonds hemorrhaged massive amounts of value, ripping a gaping hole of unrealized losses right through their balance sheet.
And then the liquidity crisis hit, $42 billion. That staggering figure represents the massive wave of non-maturing deposits that panicked tech startups try to pull from SVB almost instantaneously, fueled entirely by group chats and social media panic.
But here's the kicker. They only had $13 billion in highly liquid cash on hand. When $42 billion tries to sprint out the door and you only have $13 billion in the vault, well, collapse isn't just a possibility. It's a mathematical guarantee. They were forced to sell off those underwater bonds, transforming unrealized paper losses into actual bankruptcy. So, how do we fight back? Section 5, the risk manager's defense.
Let's open the playbook to see how we protect the money sitting in your checking account right now.
A bank's internal defense relies heavily on ALCO, the Asset Liability Committee. Think of them as the brain trust. They're deploying ruthless, worst-case scenario stress tests. They are building massive cash and liquid bond buffers to absorb systemic shocks. And they're constantly using dynamic ALM matching to ensure the lifespan of their assets safely aligns with how sticky their deposits actually are.
On the regulatory side, under the global framework known as Basel III, banks are forced to maintain two critical ratios. The liquidity coverage ratio, or LCR, is basically your emergency oxygen tank, ensuring you have enough high-quality liquid assets to survive a brutal 30-day panic. Meanwhile, the net stable funding ratio, or NSFR, is your long-term life support, guaranteeing you have solid, reliable funding mapped out for a full year.
Globally, this entire high-stakes ecosystem is held together by three pillars of banking regulation. Pillar 1 makes sure a bank holds enough equity capital to actually absorb losses. Pillar 2 brings in the central bankers for strict supervisory reviews and extreme scenario tests. And Pillar 3 enforces market discipline, forcing banks to transparently report their vulnerabilities to the public so investors can spot the cracks long before a crisis hits.
But ultimately, as you step out of the risk manager's shoes today, you really have to ask yourself, we've built these incredibly robust regulatory frameworks, but human behavior is evolving so much faster than the rules. In an era of instant social media panics and digital withdrawals that can drain billions in a literal heartbeat, is our banking plumbing truly ready for the next unprecedented shock? It's the ultimate question every financial institution is wrestling with right now. Thanks for joining me on this explainer, and keep questioning the systems that run our world.